We are taking $50,000 in capital and tracing it through exactly 240 months. One starting amount splits into two diametrically opposed asset classes to see which mechanism actually produces more wealth. To run the simulation, we must eliminate variables. Our two hypothetical investors are the exact same age, live in the same city, earn the identical $55,000 annual salary, and possess that identical $50,000 in starting capital. Pathway A deploys the capital into real estate. The $50,000 acts strictly as a 20% down payment. Using a 30-year fixed mortgage at 7% interest, that capital controls a $250,000 rental property. The gross monthly math looks incredibly appealing. This rental unit generates $1,800 in monthly income against a $1,330 mortgage. On paper, it produces an immediate cash yield of $470 every single month. Assessing an investment based purely on gross yield before a single dollar of real-world friction applies creates a mathematical illusion. That $470 is revenue, not profit. Pathway B takes that exact same $50,000 and drops it into a highly liquid equity vehicle, a total stock market index fund. To simulate ongoing investment, this pathway includes an automated contribution of $300 every month. The psychological divide between these two choices is immediate. Real estate provides a physical structure, keys, a tenant, and visible social proof of ownership. The index fund provides a digital confirmation email. There is no key, and there is nothing to point out from the street. To find the superior asset, we have to ignore how the investment feels on day one. We are going to test both models against 2 decades of compounding friction, uncompensated labor, and operational scale. Tangible properties are not intrinsically better than liquid digits on a screen. Over 20 years, an asset's ultimate value is decided entirely by how efficiently it survives economic friction. This vertical chart represents the theoretical gross cash flow of the real estate property over its first 36 months. Collecting roughly $64,800 in rent, minus $47,800 in mortgage payments, leaves a towering $16,920. But capital requires defense. The first deductions are unavoidable macro costs. 3 years of property taxes subtract roughly $9,000, and hazard insurance consumes another $4,500. Next comes capital expenditures, or CapEx, physical structures decay. A $1,200 water heater replacement and a $2,800 roof repair compress the margins even further. Finally, we apply statistical vacancy. 1 month of an empty property, plus basic cleaning and relisting fees, burns another $2,400. That initial $16,000 projection is crushed into a tiny final net sliver of just $2,000 to $4,000 over 3 full years. That tiny margin exists only because the investor bypassed the 8 to 10% property management fee. To keep those few $1,000s, they traded their weekends and lunch breaks to coordinate repairs and handle tenant phone calls. Compare that to the liquid equities model at year 3. Growing at roughly a 10% average annual return, that portfolio sits around $76,000. There were no emergency capital requirements and 0 hours spent managing the growth. The cash flow narrative sold to retail investors omits a core reality. Gross real estate yields look high because they require the ongoing conversion of your capital into uncompensated operational labor. By year 10, we see the true wealth engines for both pathways engage. For real estate, that engine is bank leverage. A 5-to-1 ratio means $50,000 controls a mass 5 times its size. When the market appreciates at a modest 3 to 4% annually, that growth applies to the entire $250,000 structure, not just the down payment. By year 10, that leverage drastically widens the investor's equity to somewhere between $170,000 and $184,000. This equity boom offsets the operational reality. By year 5, major CapEx events like an $8,500 roof replacement drive the actual cash-on-cash return down to an entirely mundane 3 to 5%. On the right side, approaching year 10, the equities pathway begins expressing this mathematical equation, exponential compounding. The curve of this graph begins to tilt vertically. The portfolio starts generating enough gains on its previous gains that the internal growth is dwarfing the investor's $300 monthly inputs. At year 10, both investors reach an exact parity. Both hold approximately $170,000 in net wealth. One built it through structural leverage debt, the other through friction-free mathematical scaling. Equities demand zero physical labor, but they extract a brutal psychological toll. The specific risk here is extreme volatility. During a crash, a stock investor watches decades of wealth evaporate in weeks. In 2008, the market dropped roughly 37%. In March of 2020, it plummeted 34% in a single month. This forces investors to endure deep drawdowns without liquidating. Real estate shields you from daily ticker anxiety, but introduces severe concentration risk. Your capital is localized to a single asset and heavily dependent on specific humans. One tenant refusing to pay can trigger a legal eviction that burns 3 to 6 months of lost rent, wiping out a full year of profit in one event. At exactly month 240, the models converge. The leveraged property and the liquid index fund land in the exact same range, somewhere between $400,000 and $500,000 in total net worth. Achieving that $500,000 in real estate cost the original down payment, an additional $20,000 to $35,000 in mandatory out-of-pocket replacements, and hundreds of hours of manual labor over 20 years. Achieving that same $500,000 in the stock market required $122,000 in total contributions over 2 decades, 0 emergency cash injections, and 0 labor hours. Over $300,000 of the final balance was purely the result of automated math. A 20-year investment horizon requires selecting a specific form of friction. You either endure psychological market drawdowns or manage physical operational demands. The defining difference between these models is scalability. If we adjust the equities pathway by increasing the monthly contribution by just $200, the entire outcome fractures. That marginal increase multiplies rapidly through the compounding equation. The 20-year equity balance explodes from $460,000 up to roughly $600,000. The investor generated a massive leap in wealth with zero added workload. Scaling real estate yield is entirely linear. Generating a proportionate increase in wealth requires applying for a new mortgage, saving another 20% down payment, finding another tenant, and perfectly doubling your operational workload. Real estate definitively outperforms in specific, advanced setups. If you secure a property where monthly rent exceeds 1% of the purchase price, the math turns heavily in your favor. If you use house hacking to rent out adjacent units and drive your personal living expenses to zero, the immediate savings are massive. Furthermore, physical properties provide legal tax shelters. Property depreciation legally offsets taxable income, and 1031 exchanges allow you to roll capital gains directly into new properties tax-free. Mechanisms that stock investors outside of a retirement account cannot replicate. The distinction is clear. Real estate is a scalable business. Index investing is scalable capital. Treating a rental property like passive capital leads directly to miscalculated returns and severe operational burnout. Both of our hypothetical investors committed their $50,000, believing they had found the proven, mathematically superior path to wealth. Making a 20-year financial commitment based on barbecue conversations, social proof, and gross return headlines is an error. Whenever an investment yields high top-line numbers, demand a full lifecycle model. Map out the mandatory capital expenditures, calculate the uncompensated labor, and price in the risk of catastrophe. Precision is the prerequisite for building wealth. An investor's asset choice must align with their specific capacity for uncompensated labor or their tolerance for market volatility.